As a financial coach, the question I most often get asked by friends at parties is, will you teach me to invest? Most people think it's equivalent to learning a new language or figuring out chemistry, neither of which I'm very good at. The truth is, there are tons of different ways to invest. Some investments require large upfront amounts of money, like buying real estate. Others require knowledge of a new technology, like investing in a startup idea. But today, we're gonna talk about investing in the stock market. Why? Because it's the most widely accessible and democratized investment opportunity. Well, besides crypto, but we'll save that for another video. Anyone can invest in the stock market. It doesn't require a huge upfront investment, and no one is screening you to decide if they want you to invest in their business or not. So, what do you need to know before you invest in the stock market? Keep watching to find out. Hey, I'm Britt, co-founder of Dow Janes and financial investing coach, and this is everything you need to know about the stock market. If you want more tips on how to invest and make the most of your money, definitely subscribe and hit the bell so you don't miss our future videos. And give it a thumbs up if you like it. It means a lot to us. Okay, so first things first, how the stock market works. The stock market is a place to buy and sell small pieces of public companies, called shares or stocks. These shares and stocks are organized into exchanges, like the New York Stock Exchange or the NASDAQ. And if you were to think of the stock market like a farmer's market, the stocks would be the fruits and vegetables, and the exchanges would be the vendors' stalls. But unlike picking up an Instagram-worthy bouquet of sunflowers at the Saturday morning farmer's market, you can't just go in and buy stocks. Instead, you have to go through a broker, like E-Trade, Robinhood, or Vanguard. You can think of that like going to the farmer's market during COVID when you couldn't touch the fruit yourself and the vendors had to hand you what you wanted. Basically, the vendors are like the brokers. So similarly, on the stock market, you have to place your trades, the buying and selling of stocks, through a broker. So now that you understand the lay of the land, let's dig into what you need to know about investing in the stock market. But first, a history lesson. So this is a historic look at the S&P 500. The S&P 500 is an index that measures the performance of the largest 500 companies in the United States. And you can see how the S&P 500 has changed over time. Even after the worst stock market crashes in 1929 and 2008, it still came back to record highs in the years after. In fact, there hasn't been a single 20-year period in which the S&P 500 had negative returns. And over the past 9 decades, it delivered an average rate of return between 6 and 8%. And this is an important fact to know about when you're starting to invest. Why? Because this means that if you can stay invested, as in not pull your money out when the value goes down, you have a good chance of making money over the long term. So that brings us to our first stock market investing strategy, buy and hold. If you can put your money in the stock market and not touch it for 5+ years, you will likely make money. It's as simple as that. Stay tuned and I'll tell you how to actually put your money in the stock market. But the trick to all of this is not taking it out when it goes down, which is why we really emphasize the importance of having an emergency fund in place before you start investing. You don't want to be forced to take it out because you need it, and you don't want to react emotionally when it dips. You want to be playing a long-term game if you want to make money. Now, if you're worried about starting to invest because the market is at an all-time high, I'd like you to look at this graph again. At any point in history, unless it was immediately after a crash, the market has always been at an all-time high. That's because companies are growing and innovating and contributing to a growing stock market. So as long as you plan to be invested for 5 or more years, the best time to get invested was yesterday. Like Warren Buffett says, it's not about timing the market, it's about time in the market. Okay, so now that you've got your long-term buy and hold strategy down, next we're gonna talk about what to actually invest in. If you're like most people, you probably think that investing in the stock market means picking stocks. And depending on how much research you've done, and no, the smart guy at work told me to buy Walmart stock, doesn't count as research. We like to equate picking stocks to playing roulette. You're putting your money on a single company and really hoping your bet wins. Now, of course, there is a time and a place for single stock bets, which we'll talk about next. But first, another farmer's market analogy. Imagine that your partner went to the farmer's market and came back with 3 baskets full of kale. What would you think? I would think, was there a sale on kale today? And then I would think, how am I ever going to eat 3 baskets of kale? I don't even like kale that much. But mostly, I would be super bummed that my partner didn't get avocados and blueberries and apricots and cherries. And this, my friend, brings us to a lesson in diversification. So to take it one step further and really bring this point home, imagine that when your partner picked up the kale, it was covered in bugs and you had to throw all of it away. You could say that our investment in kale went to 0. And had we had some avocados, blueberries, or apricots, we might have been able to pull together a nice little snack. And that's what you want to do when you invest. You want to get a little piece of a lot of different things so that you're not overexposed to a certain industry or company and therefore reduce your risk of loss. That's what you want to do when you invest. You want to get a little piece of a lot of different things so that you're not overexposed to a certain industry or company. This allows you to reduce your risk of loss if one company or industry performs poorly. And the easiest way to do this is by investing in low-cost index funds. Index funds give you broad exposure to large segments of the entire stock market with a single fund. For example, if you wanted to get exposure to the largest 500 companies in the US, you could invest in the Vanguard 500 Index Fund or the Fidelity 500 Index Fund, for example. So to bring the farmer's market analogy back in, an index fund is like a smoothie. It's filled with hundreds of tiny pieces from the entire market. The good news is getting started investing in index funds is actually easier than even making a smoothie. So first, what you do is you pick an index. If you're just starting out, a broad-based index like the S&P 500 or a total market fund is a good place to start. Or if you want a completely hands-off approach, you can look for target date index funds. Target date index funds are funds where the allocation of stocks and bonds within the fund changes over time based on the year you plan to retire. So as you get older and closer to retirement, the fund moves from being mostly stocks to being more evenly weighted between stocks and bonds. To actually find the fund that you're interested in investing in, you can just Google the name of the brokerage, like Vanguard, Fidelity, or Schwab, and then the name of the index or the market you want to invest in, like Total Stock Market Fund, or 500 Index Fund, or Target Date Fund. Then you want to look for index funds that have the lowest fees, also known as expense ratios. So for example, Fidelity's 500 Index Fund has a 0.02% expense ratio. Vanguard's Total Stock Market Index Fund has a 0.04% expense ratio. Vanguard's Target Date Funds have an expense ratio of 0.15%. Basically, anything less than a 0.3% for the expense ratio is reasonable. So you'll see that across the board, they tend to be quite low. You could go up to 0.3% if there was a fund that you were quite interested in. Now, when you go to actually get invested, you'll notice that some index funds have a minimum investment requirement of anywhere from $1,000 to $5,000. And if you haven't saved that much, but you want to invest using this broad, diversified approach, you can either find an index fund with a $0 minimum investment, or you can find the equivalent exchange-traded fund, also known as an ETF. To actually make these investments, you'll have to open an investment account at one of the brokerages. You can do this through your retirement account, like a 401k or an IRA, or by opening a general investing account. Okay, so we have talked about long-term investing, diversification, and index funds. And the last thing I want to cover today is picking stocks. So earlier we equated picking stocks to playing roulette, and that's really the best way to think about it. If there's a single company you really want to place your bets on because you have a brilliant investment thesis about why this company is really going to kill it, then go for it. But only invest as much money as you're willing to lose. If you choose to invest in a single stock, just do it with a small percentage of your investment portfolio and then put the majority of your investment portfolio in index funds. Index funds are great. They've historically performed well, they have low fees, and they offer incredible diversification. So this is a great strategy for the majority of your investment portfolio. And remember, the best way to lose money in the stock market is by pulling out your money before the market has time to recover. So don't react to the daily news cycle. Set it and forget it. You're playing a long-term game here. Pick your index funds, invest your money, and leave it alone. All right, that is everything you need to know about the stock market to be a successful investor. And if you're interested in learning more about investing and how to build wealth and doing so in a community of women, then check out our free class. I'll link to the description in the comments below. And if you found this helpful, please give it a thumbs up or share it with a friend. It means so much to us. All right, thanks for watching, and I'll see you in the next video.